There's change in the air. Our property markets are showing promising signs. Auction clearance rates are up, asking prices are up, interest rates are down. So the big question buyers and sellers are asking are we there yet? In other words, have we hit the market floor? Welcome to this month's Property Insider Market Update. We are a chat with Dr. Andrew Wilson, Australia's leading housing economist and chief economist for myhousingmarket.com.au. And together we're going to bring you up to date on what's happening in our property markets around Australia. Welcome, Andrew.
Hi, Michael. How are you today?
Good, thank you. Well, let's start with the elephant in the room. This month, interest rates were cut.
Okay.
It was no real surprise. The likelihood of an interest rate cut kept coming up throughout June, particularly since GDP figures were a little bit weak in the beginning of June, and following Governor Phil Lowe's speech saying that a single cut isn't going to be enough to shift the path we're on. Andrew, in my mind, they're targeting unemployment. They want unemployment rate to drop to the low 4% to soak up what they say is spare capacity in the unemployment market. I think they want to stimulate wages. They want to boost the general economy. Is that how you're seeing it?
Well, that's right, Michael. Of course, that's what the rule book demands, that you cut interest rates to create competition for labour, which then pushes up wages and prices, and we get back to the incomes growth, and that creates consumption, and we're back to having a sense of prosperity in the economy, which we've sadly lacked now for a number of years. But we're not alone in this boat. Most advanced economies have experienced this lack of drive from record low interest rates, have failed to drive higher incomes and inflation. So I'm reasonably pessimistic that these belated actions by the Reserve Bank will get the result that all others have failed to achieve, with much lower interest rates than what we have at the moment.
Well, one of the problems with employment is that one of the big employers was the construction industry.
Yes.
And forward estimates of new construction jobs.
Yes.
So what's that going to mean, Andrew?
Well, where are the jobs going to come from, Michael? It's one thing to say we're going to cut rates until we get to an unemployment rate which will fuel higher incomes through increased competition for labour, as you said, soaking up the existing labour pool. But where are these jobs going to come from? We have seen a sharp decline, as you suggested, in construction. Both commercial and residential construction has tanked. We have really nothing coming through in the back. We must recognise that a lot of the economic drive, a lot of the employment growth we achieved post the end of the mining boom came from construction. So we're not going to get that same drive, certainly in the short term. And the other major driver of employment is the retail sector. And of course, that's as flat as a tack as well. No surprise, technological change has impacted bricks and mortar retail. And of course, low incomes growth has worked its way into low consumption.
Before we get into the property markets, let's just have a look at the economy. Globally, the major story this month has been the tensions between the United States and China. And if they persist, it could impact economic growth, GDP around the world. But we've seen some more positive signs and some positive tweets from Donald Trump recently. Domestically, though, it's old news now, but the March quarter GDP figures, the growth was low. It meant our annual pace of growth had dropped from 2.4% now to 1.8%. It's the slowest growth in our economy since just after the global financial crisis in 2009. So I can see why the Reserve Bank's keen to stimulate our economy. And you were talking about employment a moment ago, Andrew. We created more jobs in May. Job unemployment was steady at 5.2%. 42,300 jobs were created. It's the strongest monthly job growth in 12 months. But participation rate went up, the highest ever, 66%. But as I dug into it, Andrew, 39,800 new part-time jobs. There are only 2,500 full-time jobs. Now, I know there was an election that month because these month figures are old figures, but it's not a particularly good sign for employment growth.
Well, the unemployment rate in the labour market is a notoriously lagging indicator of the real economy, Michael. Employers act because of the rigidity of the labour market. They act, I guess, after the fact. Obviously the Reserve Bank is now trying to get ahead of the game. I think it's more the Reserve Bank strategy is about reducing the unemployment rate rather than keeping it steady because they're concerned about where the economic growth is going to come from. And what concerns me with interest rates is that if we get an expected or unforeseen economic shock, we're not going to have any ammunition left to counter that, given that we're cutting now in a period of reasonable economic activity. But make no mistakes, Michael, it will mean higher house prices, which is a positive and will have positive impacts for the economy.
So back to property now. Has the property market bottomed after 2 years or so of Sydney and Melbourne prices falling and some other cities softening in price growth due to tighter credit? I think the bottom is very close. I know one thing for sure, Andrea, having been in property for over 40 years, we're never going to know that till it's passed and we're now having growth again. I know one of the metrics you measure are auction clearance rates, and I've seen your figures and there are some interesting trends emerging.
Yeah. Well, certainly, Michael, auction clearance rates tell us what's happening on a weekend by weekend basis. Particularly the Melbourne and Sydney markets are quite a robust reflection of the general activity in the housing market. The June auction clearance rates are certainly the highest we've seen for nearly 2 years in both Sydney and Melbourne. The trend is clearly upwards. We've now got clearance rates hovering around the 70% mark in both Sydney and Melbourne weekend on by weekend. And that, of course, those levels always reflect higher prices as we see more competition for property and auction markets. That's not the whole story, Michael. It's not just about clearance rates, although they clearly do indicate market energy and price energy. You also have to look at the other factors behind the clearance rates, and that's the number of listings, also the number of sales and turnover. And when we look at those metrics over the month, we can still see that despite higher clearance rates, we still have trepidation from sellers. Listing numbers are still quite low compared to last year and generally. And we also look at the sales number, and it's only, and I think this is interesting, that the Sydney market is now tracking with higher numbers of sales than it did over June last year. So this is a real positive sign for the Sydney market particularly. And turnover, of course, is also very important. And similarly to sales numbers, we're seeing that the turnover of properties sold by auction in Sydney is now also higher than where it was last June. Now, Melbourne is still struggling with sales numbers and listing numbers and turnover, but certainly we could, on those metrics, say that it's very close to the bottom of the market for Sydney and approaching that for Melbourne as well. So the trend is clear. We shouldn't be surprised. Lower interest rates clearly are a catalyst for a rebounding property market, the one that's been absolutely impacted by confidence. And as we discuss continuously here, Michael, the fundamentals in just about all our capital city markets certainly remain positive for demand over supply.
Interestingly, Andrew, it's going to upset all those property pessimists and the ones who've been leaving tweets, nasty tweets and nasty comments on our videos. They seem to have disappeared as the news is becoming more and more positive. Now, by the time we know what's going on, it will have already happened because the sales would have occurred a couple of months ago and then they're eventually reported. But I know what you're doing is looking at a different index, the asking price index, which is an in-time real index of what's actually happening, which down the track very much correlates with sales that have occurred. What are you noticing with asking prices around Australia?
Well, look, monthly asking prices and monthly price models, Michael, are notoriously volatile, and there needs to be a number of adjustments made in terms of property mix, and that reflects seasonality to some degree. There's no doubt we're starting to see a trend of a flattening price models. That is, that the declines that we've clearly seen over the last year are now starting to level out. Over June, we saw asking prices in Sydney actually rise. Melbourne remained flat, and most other capital city markets remained flat as well. The smaller markets tend to be more volatile with those month-to-month figures because of lower observations. But asking prices are now starting to settle. We still have a lot of property for sale at the moment, and that, of course, is just a product of what has remained generally a market where the fear factor has dominated for the past year or so. But there's no doubt that those grey clouds are starting to clear, and we're starting to get a few spots of blue appearing now. And I think that trend is clearly now becoming evident. And most, other published price models are showing the same outcomes. I was amused, Michael, to read, and gets back to, I guess, your doomsday commentary just before, that there was a prediction that prices are going to rise by 15%. I thought, oh, here we go again.
Well, the media loves booms and busts. And unfortunately, we're going to be a bit disappointed because it's not going to be either in the next little while. There is momentum occurring in the market from a number of factors. So let's quickly look at them. There's increased confidence now that the election's over. It's an old thing, but that created a bit of confidence to get things going. We know APRA is easing their current restrictions on lending, but that hasn't come through yet. There's been 2 interest rate cuts. Banks are starting to pass on those home loan rates, which are good, but some are not going to pass on the full cut in rates. We had a separate session just recently when we discussed affordability, the best it's been for a long, long time. There are positive messages in the media. That stokes our confidence. That's good. First home buyers, they're back in the market. So what's ahead? I agree with you, Andrew, that we're likely to bottom out in the next little while. Property values are likely to be a little higher by the end of the year. But look at it, even though you can service loans, it's still going to be hard to get a loan. So I think the Reserve Bank's appreciating that. It recognises we can drop interest rates and we can make it easier for businesses and we can make it easier for some people, but APRA is going to do the hard work by making it harder for the banks to lend money. And if that's the case, we're not going to see a boom this time around. But that's a good thing, Andrew. We don't want another boom.
No, Michael, but we've got to stop looking in that rear vision mirror to determine what's going to happen ahead. It is a much more moderate environment in terms of particularly the cost of money. Now, one thing you've got to understand, Michael, is that the lower interest rates go into uncharted territory, the less profit opportunities that banks have. Now, banks really can't cut deposit rates to zero, because why would you put your money in the bank if you're getting basically nothing for it? Now, banks make money by borrowing money from consumers and then lending it out to other consumers and having a margin between the two. Now, the banks are at a rock and a hard place here because they can't really cut their deposit rates according to the cuts in official rates and maintain their profit levels. So that makes it very difficult for them to pass on the full RBA rate cuts. But the thing is that banks are now snookered by low lending levels, and that means low profit levels, which exacerbates the margin issues.
So another interesting month in property. In between these monthly property market updates, we have our regular weekly Property Insider videos. Thanks for your time, Andrew.
Thank you very much, Mike. There's no doubt, as you suggested, that confidence has been the first cab off the rank over the past month. We're really yet to see the impact of the cuts to interest rates on the actual buying and selling environment. And of course, something else to look forward to is now the tax cuts look to be passed. So we'll have more income to substantiate those potential house price increases. But it's nice to be positive for a change, isn't it, Michael?
It is, but we're always realistic.
We're always positive.
We're realistic, which is good. Thanks for your time, Andrew.
Thank you, Michael.